Marcus Whitfield, we need to speak with you about several loan files.
For 5 years, Marcus Whitfield approved fraudulent loans as a senior credit union officer. Then investigators discovered he was also the man reviewing his own fraud for the audit committee.
I've built this credit union small business portfolio for 15 years. I think carefully about how you handle this.
You're about to accuse someone who sits on the committee that reviews cases exactly like this?
He would not get the chance to explain this one away from a hospital recovery room. Within weeks, investigators would trace $1.4 million funneled out of a member-owned credit union through 23 fraudulent loans, none of them large enough on their own to trigger a second signature. All of them routed through relatives, an old college roommate, and men recruited off a barbershop chair. The one compliance report that finally caught the pattern landed on a new hire's desk during the exact 6 weeks its architect was home, recovering from surgery, unable to walk it back the way he reportedly had every time in 9 years before. For years, he had also sat on the very committee responsible for catching fraud like his own. What began as one favor for a struggling cousin would end with federal prosecutors dismantling a scheme built entirely on a senior loan officer's own signature, and on the fact that, for years, he was also the man reviewing his own work. Here's what gets me about this one. He sat on the committee meant to catch fraud exactly like his own. Would you have caught it? Drop your answer in the comments and subscribe if you want more of these every week. Marcus Delray Whitfield was born in 1982 in Spokane, Washington, the only son of a machinist who worked the rail yards on the city's east side for over 25 years, and a mother who managed the deli counter at a neighborhood grocery store. Money in the Whitfield household was steady but never generous, and Marcus grew up understanding, in the specific way kids of working families often do, exactly how much a missed paycheck could cost. He played baseball through high school, good enough to be recruited for a partial scholarship, and enrolled at Eastern Washington University in 2000 to study business finance, one of the first in his family to attend college at all. He roomed for 3 years with a classmate named Dale, a friendship built on late-night study sessions and a shared fantasy football league that would resurface in a very different form nearly 2 decades later. He graduated in 2004 and, after a brief stretch working retail while he looked for something in his field, was hired as a teller at Cascade Community Credit Union's downtown Spokane branch in 2005. His rise inside the credit union was steady, and by every internal measure the institution tracked, entirely earned. He moved from teller to loan processor within 2 years, then to junior loan officer in 2009, developing a reputation among branch managers for closing files quickly and maintaining an unusually low default rate on the consumer loans he originated. A 2013 performance review specifically noted his talent for working with small business owners who found traditional bank underwriting intimidating, a skill that made him one of Cascade's most requested loan officers among the credit union's growing base of local entrepreneurs. By 2015, he was handling the credit union's more complex small business lending, and in 2018, after 9 consecutive years of clean performance reviews, Cascade's leadership promoted him to senior loan officer and granted him delegated underwriting authority to approve loans up to $75,000 without requiring a second signature, a threshold the credit union reserved for its most trusted officers. He married his wife, Danielle, a physical therapist, in 2011, and they raised 2 children in a modest home in Spokane Valley. He coached his son's Little League team for 3 seasons and was, by most accounts from coworkers and neighbors alike, exactly the kind of steady, dependable person a small credit union built its underwriting trust around. His personal finances told a different story, starting in 2017. That year, Whitfield partnered with his old college roommate Dale on a real estate flip, purchasing a duplex on Spokane's north side with plans to renovate and resell it within a year. The project ran badly over budget. The housing market in that specific neighborhood softened before they could sell, and by early 2018, Whitfield had personally absorbed roughly $60,000 in losses on a project he had financed partly through a home equity line against his own house. Therefore, in the same year the credit union handed him the authority to approve loans up to $75,000 entirely on his own signature, Marcus Whitfield was quietly underwater on a failed real estate bet with the one old friend who, within months, would become the very first name on a loan file that did not exist for any reason he was willing to put in writing. Credit unions, as member-owned financial cooperatives, are chartered and insured under a regulatory structure distinct from traditional banks, but they rely on the same fundamental control that governs nearly every lending institution. A tiered underwriting authority that grants individual loan officers the ability to approve loans up to a certain dollar threshold on their own signature, with anything above that threshold automatically routing to a second officer or a loan committee for independent review. That threshold exists specifically to catch errors, conflicts of interest, or fraud before a loan is funded, and the dollar figure attached to it is calibrated to the officer's tenure and track record, a system built to reward experience with autonomy. Cascade Community Credit Union's board had granted Whitfield a $75,000 unsupervised approval threshold in 2018, based on 9 years of exactly the kind of clean, low-default performance the system was designed to trust. Board minutes from the approval discussion, reviewed later by investigators, described the decision as a natural next step for an officer who had, in the words of one trustee, never given this institution a single reason to look twice. What the threshold did not account for was a loan officer who understood, better than almost anyone else in the building, precisely how the second signature trigger worked, and precisely how to structure a fraudulent loan file to stay just beneath it every single time. Compounding the gap further, Whitfield also served on Cascade's Internal Loan Review Committee, a rotating quality assurance body responsible for periodically auditing a sample of closed loan files across all officers to check for underwriting errors or policy violations. For several years of the scheme, that responsibility put Whitfield in the position of occasionally reviewing his own fraudulent files as part of routine committee spot checks, a conflict nobody at Cascade had structurally anticipated, since the credit union's small size meant its pool of senior officers eligible to serve on the committee was itself limited. The committee's rotation schedule was set a full year in advance, meaning Whitfield's own assigned review months were a matter of public internal record he could, and did, used to time which fraudulent files he originated during stretches when he knew he himself would be the one checking the work. That structure, built on trust earned over nearly a decade, and reinforced by a self-review process nobody had designed with fraud specifically in mind, worked exactly as intended for 5 years. It also meant that when Whitfield decided to begin originating fraudulent loans, the one person positioned to catch the pattern early was, for long stretches, Whitfield himself. The first fraudulent loan traced back to 2018, funded in the name of Dale, Whitfield's college roommate and real estate partner, ostensibly to cover a small business venture Dale never actually registered with the Washington Secretary of State. Whitfield fabricated supporting pay stubs and a business revenue statement to support the application, approved the loan himself under his own signing authority, and split the proceeds with Dale once it funded, using his share to cover a portion of the real estate loss. Once the mechanism proved it worked without drawing any scrutiny, Whitfield expanded it methodically over the following 5 years. He recruited additional straw borrowers, including 2 relatives with clean but thin credit histories and 2 men he met through his cousin's Spokane barbershop, individuals he judged unlikely to have the financial sophistication to question the paperwork closely, or the standing to challenge him if something went wrong. Some straw borrowers understood exactly what they were signing and agreed in exchange for a promised cut of the loan proceeds. Others, according to later testimony, signed documents Whitfield presented to them with only a partial or misleading explanation of what the loan was actually for, In one case, telling a cousin the paperwork was simply a formality tied to a family favor, rather than a loan the cousin was personally on the hook for. For each fraudulent file, Whitfield fabricated whatever documentation the loan type required, invented pay stubs and W-2 forms for personal loans, and, for the small business loans, entirely fictitious business names and revenue projections for companies that existed nowhere in Washington's business registration records. Because he personally approved every file under his own $75,000 threshold, none of the 23 fraudulent loans ever routed to a second reviewer at all. To keep the loans from surfacing as delinquent during the credit union's routine portfolio reviews, a red flag that could have exposed the entire pattern within months, Whitfield periodically originated small refinance loans in the same straw borrowers' names, using the newly funded proceeds to make several months of payments on the older fraudulent loans before those payments, too, eventually lapsed and needed to be refreshed again with yet another new loan. The rolling structure kept his own delinquency reports clean during the exact periodic file audits he was, in several documented years, personally responsible for conducting. He coached his straw borrowers carefully on what to say if the credit union's verification process called to confirm employment, in at least one documented instance providing a fabricated supervisor name and a phone number tied to a prepaid phone he had purchased specifically for that purpose, ensuring any verification call would reach a number he controlled rather than an actual employer. By 2021, Whitfield had also begun asking a teller he trusted to process large cash withdrawals tied to certain loan disbursements without generating the credit union's standard large transaction report. Framing the requests as accommodations for a valued personal loan client rather than anything requiring scrutiny, requests she complied with over multiple occasions without fully understanding their significance at the time. By late 2023, the scheme had grown to 23 fraudulent loans spanning 14 straw borrowers across 5 years, with a combined total of $1.4 million diverted, every single loan structured to fall just under the $75,000 threshold that would have automatically triggered a second officer's review. Whitfield used a portion of the proceeds to fully repay his home equity line from the failed real estate flip by 2020, and the rest largely funded ordinary family expenses and a modest lake house down payment in 2022. A purchase colleagues recalled him attributing to a wise decade of saving, rather than anything drawing suspicion at the time. In September 2023, Cascade's core banking system, running a routine fair lending analysis mandated periodically by the National Credit Union Administration, flagged an unusually high concentration of loan originations tied to a small cluster of member zip codes. The report, which in an ordinary year might have been absorbed quietly into the loan committee's normal review process with Whitfield present to offer context, instead landed squarely on the desk of a newly hired compliance officer, since Whitfield happened to be on medical leave that entire month recovering from a scheduled surgery. Unavailable to informally explain away the pattern, the way colleagues later told investigators he reportedly had in past internal reviews, the compliance officer, working through the flagged files without any of Whitfield's usual context, pulled the underlying loan documentation for the small business loans in the cluster, and found that 4 of the businesses listed as loan purposes had no registration whatsoever with the Washington Secretary of State, no discoverable online presence, and no listed employees anywhere she could verify. She later told investigators that in a normal review cycle, she likely would have simply asked Whitfield to clarify the discrepancy in person, a conversation she now believed, based on colleagues' accounts of his usual explanations for similar red flags, would have ended with the concern quietly resolved rather than escalated. That discovery, made only because the one person capable of explaining it away happened to be recovering from surgery at the time, opened a formal internal investigation that would, within weeks, become a joint referral to the National Credit Union Administration's Office of Inspector General and the FBI's Spokane resident agency. The internal investigation and subsequent federal inquiry pulled the full loan disbursement history for all 23 flagged files and found 19 of them had proceeds wired, in whole or in part, to 2 personal bank accounts traceable directly to Whitfield within 48 hours of each loan funding. A pattern investigators described as essentially indistinguishable from him simply paying himself. The remaining 4 loans, where proceeds had gone more directly to the straw borrowers themselves, were resolved when investigators interviewed those individuals and found each described receiving a flat cash payment from Whitfield in exchange for signing loan paperwork they acknowledged they had not fully read or understood at the time. Investigators recovered text messages from Whitfield's work phone in which he explicitly coached a straw borrower on how to handle an employment verification call, including the fabricated supervisor name and the prepaid phone number. A piece of evidence that made clear the fraud was deliberately engineered rather than the product of careless underwriting. A review of Cascade's internal loan committee minutes going back 5 years showed Whitfield had personally signed off on the quality review of at least 9 of his own fraudulent files during that period. A documented conflict of interest investigators flagged as central to how the scheme survived as long as it did without internal detection. The former teller Whitfield had asked to process unreported cash withdrawals came forward once contacted by federal investigators, describing the 2 specific instances in detail and confirming she had complied without understanding, at the time, what the withdrawals were actually funding. She also recalled Whitfield specifically thanking her afterward with a gift card, a small gesture she said at the time felt like ordinary workplace kindness, and only in hindsight recognized as something closer to payment for her silence. The smoking gun was the combination of the wire disbursement records and the loan committee's own self-audit paperwork together. 19 loans funding directly into Whitfield's personal accounts, and 9 of his own fraudulent files bearing his own signature as the reviewer who had cleared them. On November 14, 2023, at 7:40 in the morning, FBI agents and an NSHUA Office of Inspector General investigator approached Whitfield in the parking garage of Cascade's downtown branch as he arrived for his first full week back from medical leave. "Marcus Whitfield, we need to speak with you about several loan files tied to your underwriting authority," the lead agent said. Whitfield set down his briefcase slowly. "I don't know what you think you've found, but I've built this credit union small business portfolio for 15 years. I'd think carefully about how you handle this conversation. 19 loans wired directly into your personal accounts within 48 hours of funding." His expression didn't change, but his voice dropped lower. "You're about to make a very serious accusation against someone who sits on the very committee that reviews cases like this. I'd want to be certain before I did that." "We're certain. We also have the text messages coaching a straw borrower on a fake employer." For a moment he said nothing, his jaw working slightly. "Whatever you think this looks like, you don't understand how lending actually works at an institution this size. We understand exactly how it worked. That's why we're here. You're going to regret how this conversation started once my attorney sees what you actually have." "We have what we need, Mr. Whitfield." He didn't answer that one. His hands, gripping the briefcase handle, tightened until the leather creaked. "I'm not saying another word without my attorney present," he said, his voice flat now, rather than commanding. He was placed in handcuffs in the same parking garage he had walked through every morning for 18 years at 7:48 a.m., 3 days before he was scheduled to resume his seat on the loan review committee. The trial is next, and one of his own co-workers testifies against him. Stick around for that part, and subscribe if you want to see exactly how this ends. Federal prosecutors in the Eastern District of Washington charged Whitfield with bank fraud, wire fraud, aggravated identity theft, and making false statements to a federally insured financial institution. A federal grand jury returned the indictment in February 2024. Facing the wire disbursement records, the recovered coaching text messages, and the loan committee's own self-audit paperwork bearing his signature, Whitfield's attorney initially sought a plea limited to the bank fraud counts alone, an offer prosecutors declined given the aggravated identity theft evidence tied to the straw borrowers whose signatures had been used without full disclosure. Whitfield ultimately pleaded guilty to all 4 charges in June 2024 rather than proceed to trial. At sentencing, the former teller who had processed the unreported cash withdrawals addressed the court. "I trusted him because everyone trusted him," she said. "He sat on the committee that was supposed to catch exactly what he was doing. I keep thinking about how many other files I processed for him without asking a single question, because why would I have? He made sure of that for 15 years before I ever had a reason to wonder." The court sentenced Whitfield to 11 years in federal prison and ordered $1.4 million in restitution to Cascade Community Credit Union and the Enqua Share Insurance Fund, which had reimbursed the credit union's losses under its federal deposit protection. He was permanently prohibited from working in any capacity for a federally insured financial institution for the remainder of his life. Dale, the college roommate whose name had appeared on the scheme's first fraudulent loan, was charged separately for his role and reached his own plea agreement, receiving a sentence of 2 years for his more limited participation. Cascade Community Credit Union restructured its loan review committee following the case, mandating that committee members be barred from reviewing any file they had personally originated, a policy change the credit union's board later acknowledged should have existed years before anyone thought to write it down. The credit union also began requiring a mandatory second signature on any refinance loan tied to a borrower's existing loan already on file, closing the specific rolling refinance loophole Whitfield had relied on for years to keep his fraudulent accounts looking current. He spent 5 years as the one person positioned to catch fraud like his own. The case waiting on the right-hand side didn't need an inside man at all, just an outsider nobody thought to question.